But
Hello and welcome to a super special edition of the Real Estate Macro Podcast. I've got my friend Stefan Tsvetkov to join us today to talk about quantitative real estate and really, frankly, one of the sharpest minds I've met in the entire industry, and wanted to bring him on and share what we talked about because it was so interesting. Stefan, first of all, thank you for joining us. And can you tell us a little bit about your background and how you got involved in the industry?
yeah, thanks, Douglas. Appreciate the nice introduction. Very kind words there. So myself, I'm Eastern European originally. So I came to the States at 22 for grad school. So I did financial engineering, as you know. As far as like my previous background, and so I worked in the financial industry for about a decade, and then in the recent few years, I've been a real estate investor. And I do data-driven real estate investing, if you will. So I would write my own scripts and try to find deals and try to identify markets and things like that. So
and and for those who don't understand or know what financial engineering is, can you tell us a little bit about the work you did and what the mathematics of the program is like?
Yeah, sure. Yeah, financial engineering. So just basically for your audience, it's basically the application of like kind of math and coding to finance. I mean, it's really like there wasn't like that much machine learning, I guess. Like when I did it, even in a way, it was not, or they didn't call it that. In a way, there were like similar methods, but now it's like kind of things have transitioned more to be with the labels of like data science and machine learning and so forth. But it's really like any quantitative methods. There's a lot of kind of advanced probability, if you will. There's like stochastic kind of like, there are things like stochastic processes, like advanced sort of like probability type of concepts in it. There's some the other quantitative methods. There's a lot of coding and kind of running like different optimizations, simulations, like things like this. So it's just like really quantitative methods in finance, for be it risk management or like portfolio management or derivatives pricing, like option pricing, for instance, and things like that. So
and that was what I was about to ask. In a sense, it's more or less making better educated guesses with your risk, essentially, trying to quantify your risk and understand what you're really trying to bite off in terms of that.
Yeah, that's true. Or it's just even like providing, like with regards to option pricing, just even kind of providing the capacity to trade options, or like kind of like the whole market side, market enabling, if you will. And different models. Yeah, it's hard to say, like in the financial industry where you have like hedge funds not beat the market, right? Do not succeed to beat the S&P 500. It's hard to say why you have like so many technical methods built, and then you don't even have like any alpha, as they call it, or like beating the market at all. And so it just somehow how it has evolved, like financial industry is just like already like over decades, I guess some of these things have developed, and I guess they give an advantage to investment managers in some ways, like in some of the strategies, I guess, like could be a bit recession resistant, like some hedge funds run strategies in a recession too. So that could be potentially a benefit, but it's just the financial industry. It's a lot of technology, very little alpha. And so I like to switch. That's one reason I switched to real estate, that I feel like it's actually okay. So little technology, but a lot of alpha, a lot of advantage that you can get over the market. That was my main motivation. There's kind of inefficiency. You can actually be a meaningful investor who pursues returns, outsized returns on a specific deal. And even if not every deal does so perfect or so great, you have this capacity to do it. And in finance, I felt that part was a little bit difficult.
It does seem like, and I think that I've worked on this thesis, and I really started to really kind of believe it pretty deeply, that it's a lot harder to to generate any serious returns in equities, where in commercial real estate you can still do pretty good if you're just reasonable about what you're doing. It's just a significantly harder game that you're playing on the equity side.
Yeah, absolutely. And it's an interesting question because it's really, yeah, it's like, for instance, I had a colleague who used to, when I was working in finance, I had a colleague who was like, like PhD in physics, and he used to like run his own hedge fund. And so he was kind of just like kind of retired, and just working with us just to he instead of retiring basically, or he would have retired otherwise. And so he just wanted to just have a job basically, do something, right? And so he was like, instead, like all these fancy methods, and his hedge fund was like slightly ahead of the market somehow, like 0.5% or something, which is actually probably great. But it's like, what's the point of, to me, like, like kind of like, why, I don't know, like, why bother? And then there's like the arguments you can, okay, over the long run, 0.5% is a what? Yeah, sure. But I mean, over the long run, how do you know, like in your real life, what's going to happen and so forth? It's too complicated. And so, yeah, it's definitely, I mean, it's also it's a little complicated with commercial real estate to finance returns comparisons, because, also you have the real estate is kind of a business, right? So if you're generating your forced appreciation, so that part is not exactly an investment return, right? It's kind of, there's also these kind of complications that it's not apples to apples, because you do labor for it. Or even if it's the labor of finding that deal, that you have this kind of intelligence, it's kind of what the business is, right? That's like your job. And then you're going to be like, let's say, whole year searching for deals or doing something, right? So there's also a little bit of that component of which returns, if one tries to compare like the stock market to real estate now, what makes it apples to apples now? And obviously you need to have real estate that is purely passive for that to be apples to apples. But then, it is there's still a lot of advantages to private markets investing, even if you make it apples to apples and it is passive, because there's different notional sizes. You can invest in small notional sizes. The returns dispersion is huge. You can have huge returns just because you're investing in small notionals. And so there are all those things. And but yeah, it's generally a little bit complicated maybe to compare returns, but in my opinion, yeah, very attractive as far as being able to generate an advantage on specific deals and kind of how returns that are not, like the usual stock market kind of return, let's say. So.
And when did you like along the way here, like how did you discover real estate, or when did it start entering your sphere in terms of like, oh, that might be something I want to chase?
Yeah. I mean, I'm in New York City, but I lived in New Jersey for a few years in between, kind of like back and forth. So I bought a house, I bought a fourplex in New Jersey and kind of house hacked it, as they call it. It's like pretty standard. And I was living in one unit, and I was kind of living rent free, if you will. I mean, you have some repairs. It's not not perfectly rent free, is the truth, because you still, do some maintenance to that building. But it was kind of rent free for what was like a 1,500 square feet unit with a patio.
And did you do the FHA program with that, or did you conventionally finance that?
Actually, I actually first did FHA. Now I had the funds for the other one, but I just decided, let's do FHA, so I have then to invest the other capital, right?
It's an incredible loan. I mean, 3% down or something crazy like that for a fourplex. I'm like, what?
That is crazy, indeed. That's true. But then I honestly didn't like it, so it's like mortgage insurance and so forth. So it's like a repo. And I refied it, and I put in and just refied it to a conventional loan. But initially I did get it like this way, and then I kind of regret it, and I thought I should have just done a conventional loan.
But it is cool though, if you really are willing to accept the mortgage insurance side of it.
That's true.
That's right.
It's true. It's like absolutely true. It's like I can tell, like for instance, like that fourplex, like the cash flow, because interest rates were low, and it had like very good cash. The cash flow on it was maybe like 30 grand or something above the mortgage actually on this one fourplex. And so and on FHA the down payment was like 30 grand.
Yeah.
So it's like, what's your cash on cash returns? Like,
it's like crazy.
So, I know, So that is true. It does give you it does give you this. Yeah, I mean, I think it's not to go in that topic much. I think the better way is to do conventional and
Hmm.
then take your equity on a second mortgage, right? On a how much
Ah,
amount of credit, right? And then you
right.
can end up with even a zero down payment.
Yeah.
And you do it this way. You do a high LTV home equity line of credit and then ends up cheaper. So I think that's better, but
That's an interesting point. I don't know that I've ever heard that angle on it of doing a conventional and pulling some of the equity out with a line of credit. Then,
yeah,
yeah,
basically that's yeah. I mean, instead of if you do have the 20% up front, I mean, that's the kind I've been doing this in residential before my residential deals. I've done like 7 residential projects or so
yeah,
in the New York City area, all of them. Some of
yeah,
them are not cheap, like some of them are almost like the commercial assets.
yeah,
Like one of them we're selling now for like maybe like close to 2.5 million actually, and
yeah,
it's a fourplex. So it's like just could be separated in condos and all that.
yeah,
But anyways, but basically, yeah. So what in terms of that, yeah. So it's just you could use a high loan to value home equity lender. There are a few for instance, in Virginia, for some reason, has a few of those, and a lot of them run automated valuation models. And we can talk on the data side, like on automated
yes,
valuation models and things like that.
yeah,
Yeah. And some of those, for some reason, they always err on the high end. The ones of those home equity lenders that I have worked with, and they give you a high LTV, but even if they didn't give you a too high LTV, their appraisals are just all wacky,
yeah,
and you are gonna so anybody who is somebody is a primary occupant has a primary residence listening to this, I think it's a good way if they do have the 20% down payment on that for the fourplex. 3 or 4 unit towers can be less, right? But if it's 3 or 4 units, it's 20% conventional. If they do have it, it's better to do that one, and then they can go to those lenders and on their, fortunate or unfortunate, pretty wacky appraisals
yeah.
in my experience, really take out all their equity in 6 months. It takes 6 months, and again, that even if they didn't realize the value add, even if there wasn't a discount to the property or anything, even if you did nothing, if it's just your primary residence, you can take out all your investment this way. So I've done that one. Then this is my only primary residence that I've
Yeah.
had. So that was my first property, and I, took out my investment on that, and yeah, and then I
And you're
started doing
currently
it.
scaling your portfolio now with some bigger units.
Yes. So currently I've been like focusing more on commercial. So like I mentioned to you earlier, like the biggest one working on now is 60 units. It's a bit confidential for now, like all the details on
Yeah,
it. But
sure,
in
sure.
terms of, yeah, so I've been working more on the commercial multifamily, not too big ones, kind of more around 50 units type of properties for now. Some of them under 50 units even, which is, yeah, it's not the most, it's not the most, it's probably better to do like bigger ones, but that's kind of what I've been doing for now. And some of them I also JV, and some of them I get investors. So yeah.
Yeah, and it's just building momentum. I mean, in 2 years or 10, we might look back at this podcast and like, oh my goodness, he started with that, and now look at his portfolio. It's always
Oh,
about
I
momentum.
hope
So
so.
yeah,
Those I really hope so. Yeah. So
yeah,
let's
absolutely.
see. Yeah.
And to shift gears a little bit, you've done some really interesting stuff with your data science and applying it to real estate. What are some of the things that you work on for your? You've got a business called Realty Quant, and
Mhm.
what do you do with Realty Quant, and what are you trying to accomplish?
Right. Yeah. So realty quant is really a mission, if you will, for like data-driven techniques in real estate. So I just kind of try to do my best contributions. So I've like built on like different scripts before for like finding like deals in I was finding my residential deals all through like writing Python scripts and searching for deals, like let's say underwriting like maybe like about few thousand multifamilies in the small multifamilies at that time in the New York City area. And so I built my own like AVM, sort of like zeros estimate, for some like automated
Mm-hmm.
valuation model. I've tried to do like different like condition scoring for like property descriptions. It's on the machine learning side. I do some even like price forecasting. It's with all the caveats of that one, but I do that too. And I also do like real estate market valuations. Is one thing we've discussed. Like estimating which markets are overvalued. I have a model for, so again, that's under Rioticon. It's a product on our website if you want to check it. I have a model for basically in off-market inventories, in different off-market commercial multifamily inventories, modeled for value add. So like sort of getting off-market, which buildings, based on rental listings data. So using rental listings data to estimate which buildings have the most potential to realize value add at scale, but it's preliminary. You know, it's preliminary in the sense of, because it's not you don't have the real financial statements, right?
Right.
But the rental listings data, they can give you a sense. And then people who do direct to owner, they can gear their campaigns more specifically. You know, they can decide we're going to focus on just the top 20% of assets in this market, and, you know, maybe spread across few markets, just the top 20%, or things like this. Basically just gives you more intelligence or on the off-market inventories, if you will. Let's say like there can be like a host of buildings that all their rents are at market either way, and how do you care? And so you don't care about those basically, right? And so you want to see like which assets have rents below market. It goes pretty far, that model actually. It checks for also like, let's say if a building is, let's say, Class B, and it's in a given neighborhood, and if that building is charging pet fees or other fees compared to other buildings in the same asset, so are they utilizing those other income streams, or are they utilizing, so it's kind of this type of thing, or are they billing utilities to their tenants, or compared to other, you know, that's kind of maybe property specific, but still compared to other assets that are in the same class and market. And you know, like it just tries to get a sense into the income and expense components of a property based on what they have displayed on their rental listings. You know, that's all. Like a rental listing, such as like what would show up, you know, on a listing for that property, and that's really what it is. It's just like it's just like an idea to try to model commercial multifamily inventories. And since I focus myself on commercial multifamily, that's one thing that I use for my own like deal search as well. And yeah, we can touch on the overall markets topic. I think that one is usually also pretty interesting in the current environment. I think there are many reasons like people should be interested in that, and are concerned about that if we head into a recession potentially. So
and to that point, if you're ready, I'd be happy to share that with folks. I had a chance to get a peek at it, and it is an incredible model, and the data that you found was incredible.
Right. Yeah. The intuition. Do you want me to share a screen basically, or
it should be able to share now.
Okay, let me do it that way.
Yeah.
So first of all, okay, let's not get I guess into that one, but just 1 second. So I mean, so one thing that I do is like I kind of try to do a little bit like value investing. So this is done by other people, so I haven't even invented it. This is something, I mean, the big at the institutional level, it is done. I've noticed it's done by Moody's, it's done by there's that for the Atlantic University. You know, there are a few like the bigger like companies that do these type of studies. Now I haven't seen ever like their granular data and so forth, so I did basically went on and made my own, because our data, like for this Rioticon market valuations, which markets are overvalued or undervalued or fairly valued compared to their historic fundamentals of income, population, and housing supply. That's basically what it is. And so this data, we have it so at rioticon.com, actually it's available for like 3,000 US counties. So for basically all US. And so there are also metro areas. And so this is a lecture that I did on metro areas here. And so like this is showing, you know, middle of this year, like these were the most overvalued US metro areas. So specifically Boise is at the top. Boise is at the top at pretty much in everyone's model. in Moody's, and for the Atlantic University in Realty Quant, like on my side as well. And so there's like Austin, a few other cities in Idaho, Phoenix, etc. And I probably gotta pull like a states table to show you like how what picture at least I'm seeing in terms of that on the state level. And so it's really like the way like I think like some of the labels don't show up here, but it's really the higher percentages here, the more overvalued states. So it's kind of being it's like these the few Western states of California, except California though. California is seeing price reductions now, which is extremely interesting, which seems to be on its fundamentals themselves and not because it's so overvalued, because it's not so overvalued. Right. It's only 17% overvalued, but it's having like so much population, like San Francisco, like so much population loss, and so that could be like affecting. So this is a little bit conflating like some of this stuff here, but generally,
for sure,
right. But generally, so the Western states got kind of overvalued over the past 1.5 years. So
and Stefan, according to this chart, so what basically we're seeing in your data reveals, buying in one of those markets, your risk is asymmetric to the downside. You have a bigger downside risk by being in these markets, at least on the residential side and possibly even the multifamily side.
Well, yes, that is. This is based on just housing market data.
Yeah.
So it's FHFA. So it's residential. Yes, not the commercial multifamily. Now, I've done some studies for like CoStar commercial index versus this index that is here versus FHFA. And over the long run, it has like 91% price correlation. Now,
wow.
But it's not. It's still different. This is like it makes sense. They will be similar in a way because it's essentially, even if you have a big apartment building or you have a fourplex, right? It is still the same fundamentals, right? It's still kind of people who are living, who need housing, who have like their household incomes and so forth, right? So it's fundamentally the same thing, but it has a different valuation method, right? So it makes sense that they should align over the long run, but they're not the same over the short run. So so commercial assets would be different. So definitely, but this is the housing market. But to be honest, being like kind of let's say I run a webinar and like it's mostly geared to commercials there, and kind of having conversations with like commercial investors like over the past couple of years, it is basically the intuition is exactly the same as the way this map works. So I don't think it doesn't appear to me that it's a very different picture in commercial multifamily than it is. It's commercial investors are investing in the exact same states, to the very granular detail. I can tell, for instance, even if you take in the eastern half of the US and you take something like Tennessee, and now here Tennessee doesn't show the label for it, but like Tennessee, like for instance, it's a market that has more demand, surprisingly maybe, but besides Florida, actually number two besides Florida in the eastern half. And so they show up right away in this chart, and I know that that's where there's also commercial multifamily demand. So my intuition is there's like a very close. I do use this engaging and in picking markets where to buy apartment buildings for my own apartment buildings investing now. And because we pick only undervalued markets, and the reason is because I'm not able to do it for commercial so well, because just there isn't price data. That's even if you have like any data from CoStar, it's like it has histories of cap rates. There's more cap rates, but there still isn't the actual prices so well. So then you would be able to do it for very few markets, but you wouldn't be able to have the whole picture of all US and so forth. So it's not the same. Completely agree, but it is sort of a little bit of a proxy, but obviously not the same as commercial. The two are differently valued. This is the housing market, and so. And so these states, they do have more downside risk. Just to illustrate it, if we take like here, the metro areas that are overvalued to these percentages, to the right, they have like in a severe recession what decline they could see, and in a mild recession, and then just to illustrate what it is in undervalued ones, if they're undervalued, so severe recession for a very overvalued market could be like, in this case, 30 to 50%, right? And 12 to 19% mild one. But the undervalued metro areas are like 4 or 5% in a severe recession only, and 1-2% in a mild recession. And this is based off, this is not like something that I kind of make up, or how to say, this is based on these correlations here that are shown, like 87% and such, that are of back studies. So where, for instance, here is global financial crisis, most overvalued metro areas, they declined like this, like 40 to 60%. And then the undervalued ones, even in global financial crisis, they declined like only like here 1 to 4%. And so it is based on back studies for basically every recession in the past 45 years, where global financial crisis is a very severe recession example. 1990 is a very mild recession example. And I use this here, like in this kind of presentations. And like, so 1990s, very mild recession, but again, overall markets have some decline, not too big. And undervalued ones have like almost no decline at all. And so that's kind of like, it's based off like these previous like recession studies. And yes, definitely like, or how to say, like, to a high correlation, bigger downside price risk in overvalued markets. Additionally, it goes further. It goes further because I do often get an argument where, sorry, I'm just kind of jumping around, but I'm trying to open a slide.
Oh, no, there it was. I think I saw it there. Yes.
Right. I know it's kind of a lot of numbers, but just to kind of story tell it for people, it's just what this table is showing is just showing like to the left, like metro areas, how overvalued they were, and if they were, let's say, percentage overvalued for different metro areas. And then it shows in a mild recession and a severe recession, how they perform 10 years ahead. So what it says is, for instance, if you bought, so let's say you bought in Hawaii in 1990, and it was like around 50% overvalued at the time. And you got a very mild recession, and Hawaii 10 years later performed like kind of like this top bucket here, like to 16% appreciation. And then if you bought something undervalued at the time, which was the majority of places at the time actually, then it kind of performed like 54% appreciation. So it just tells you, like, if you buy at a given level of valuation ahead of a recession, ahead of even a mild recession, where for those two recessions that happened, like where price appreciation was, how it evolved. And it's an interesting table because it kind of shows that even if you get like a very mild recession and you don't get a big decline, like here, you have something over about 50%, you get a mild recession, decline only 14, not big, right? Only 14 is not that big. But what it shows is that it still matters that you bought high. It still matters that you overpaid for that market, because then that market, and think about it, this market at the time was the most booming one. So if you bought something that was 50-60% overvalued, I can guarantee you this was the best performer that cycle. This was Hawaii, this was Oregon, this was California ahead of 1990. They were the top states and different metro areas. And yet if you bought it already at this point and you got even a mild recession, everything else outperformed you. Everything else did better, just because you overpaid. And so this is like what it shows as far as, and so that's why I've been kind of speaking now on like investing in undervalued markets, and that's what my company does. So we pull data on different states. We actually searched for deals in like 25 states, which may be too broad, and we're kind of going to focus more, but like 25 states for commercial multifamily. And then we pull, and then I have like several interns who basically then they co-agents, and like we try to find like different deals and use like social media, also like web scrape, commercial multifamily, like things from social media and so forth, right? And so, but basically all that thing goes through a filter. Is the market under to fairly valued? Basically, is the market in here in the -10 to 0% range? And I only invest in like these bottom three buckets, if you will. That is my approach. And the reason is because even if you look at this thing, it's like it's almost perfectly ordered. It's almost like physics. The 50 to 60% performs worse than the 40 to 50 and down and down. And the most undervalued bucket of metro areas one can buy right now kind of outperforms. And it goes actually interesting because we can think, okay, maybe we don't get a recession. But then this thing, there was actually another study that I did, or more detail that actually, okay, that one is if you bought at the peak before a recession. But then I did, okay, if you bought for 1 up to 5 years before the peak, but then the peak happens. And at some point, 1 up to 5 years later, and then 10 years ahead, what's your performance? And what this says is that actually, if you just even average the 5 years investing even ahead of a recession that you don't know when it's going to happen, let's say if now it happens in 2 years, on a 10-year ahead basis, you still underperform if you buy the overvalued ones. And which is very interesting because on the short run, you do outperform. On a 1 year ahead basis, you heavily outperform, as we've seen also this cycle. If you more overvalued you bought on a 1 year ahead, you outperform. And that's what sometimes for most ahead of global financial crisis was the case. Now it was the case. If you bought Idaho in 2020, which was overvalued, you would have outperformed everybody else, and it gets even more overvalued. But if you bought Idaho in 2020 and you get a recession that we still haven't got, we get a recession in 2023, 3 years later, then what this is showing is that the 10 years ahead performance for Idaho is most likely going to be like at the very bottom of everything else, like right on top here. That's kind of like what, and again, like this is just based on, of course, back studies, but it's really like, it's really interesting because it just paints a very different narrative from what most investors I talk to expect. Because, and what they expect is very reasonable, actually. Like, I know they say, let's say if you buy Austin, Texas.
Yeah.
And like they say, and Austin is right now, as we saw, like around, what was it? Was around like 64%. No, 71% overvalued in this, actually. So like, that's where Austin is. And so Austin, 70%, let's say roughly. And so the most investors, the intuition that I get from speaking to them is that if you buy something at this valuation, okay, because this is a very fundamentally strong market, but if we get a mild recession, okay, prices are going to decline maybe 10, 15%, but this place is then going to outperform afterwards. But that's not what the data suggests. So that's completely the opposite picture, actually, completely the opposite. If you bought Austin, if you bought any strongest market and you buy it to overvalue that much to 70%, what the data suggests is that you're going to get something like the top bucket here. So that like this one here, like even if you get a mild recession, so it's going to underperforms other things. And there are reasons for that. It's just because you bought it too high, even though the market is very strong. If you get a mild recession, the fundamentals compress across markets, kind of. No market performs all that strong after a recession. And the delta of those is maybe going to 20%, but now you bought a 70% overvalued market versus you could have bought a minus 10% undervalued ones. It's an 80% overpayment. And you're gaining, even though Austin is still a stronger market than something else, I'm sure. But you're gaining only 20% on its fundamentals, and you're losing on everything else. And essentially, like with valuations kind of coming down after a recession, as they always did after every single recession, they kind of go back to zero.
Yeah.
And so it's interesting, yeah. And so it's not what I'm just trying to say, kind of like to maybe like passive investors also, like I've been like trying to speak to like passive investors with the thesis for investing in undervalued markets, because really, if you buy like something like this, like Austin, and if we get even a mild recession, the likelihood that it underperforms for a decade ahead is very strong. Now, after that decade, that can still be the top market, because that market has strong fundamentals. So that can still later emerge. It takes a really long time, it appears. That's all. And the same way, even if we think of Florida now, that's how it was. Florida, 2020, the prices caught up with 06 prices. Only in 2020.
That's true.
14 years. And but afterwards, Florida now is still the top state in the eastern US half, if you will, so to say. And so but it took a really long time. And so that's all. Yeah. So this is an important thing, basically, kind of, in my opinion, important where to buy. It's kind of suggesting a shift in relative performance between the Northeast, Midwest, and the West and South, which is also very counterintuitive, because if you think that the Northeast and Midwest are in the minus 10 to 20%, and the West and South are roughly in the 20 to 60%, what this is saying that even if we get a mild recession, the bottom buckets, they kind of outperform. At least historically they did. I don't see a reason why anything would be different now. I think if one thinks that it would be like dramatically different, then we need to understand, okay, why, what's driving, because it's just like basic fundamentals that generally drove the market even during global financial crisis and so forth. And so so that's about it. So that's kind of suggesting, again, like, so that's why I try to speak to like passive investors, if they can pick their projects, pick where to invest in, from different sponsors and so forth, which they are able to do, because sponsors are generally not so able to do that, but passive investors are. So my personal view is to kind of pick projects that are in undervalued markets. So those would be, they can be even to the south or fairly valued. They can be to the south, but it's going to be like places like Baton Rouge.
Yeah.
It's like fairly valued in Louisiana, like different markets in Alabama. There are markets in the Carolinas and Georgia that are fairly valued, actually. It's just not going to be Charlotte, and it's not going to be Raleigh, and it's not going to be those. But there are others that are fairly valued. Are there fairly valued markets in Florida? No. Florida is
not really.
Across the board. Yeah, Florida is like overvalued across the board. But I mean, there will be like a couple of exceptions, but it's generally across the board overvalued. But Carolinas and Georgia, they are not across the board. They have only few overvalued places, and the rest is not that bad, actually. Yeah. So one can invest even to the south in specific markets, specific metro areas that are selected to be not overvalued. It's short of like all regulatory and other concerns in the Northeast, which are completely valid. And there are reasons people don't invest, but one can invest in the Northeast. I do invest in the Northeast myself, just because I am in the Northeast and because it happens to be under fair valued right now. So that's kind of why I do it. But if one is able to navigate, those things, then that's also doable. The Midwest, obviously, like Midwest, different markets as well. So that's generally almost nothing to the West is fairly valued, almost nothing, unless you go to kind of paradoxically California, actually, which is California is expensive, but it's more fairly valued.
That's interesting too. That's the first time really seen California really in that light. And maybe it's because so many people are bailing. I don't know. Maybe that's part of it. A lot of people have left. So that's very fascinating. Because usually you just view California as, you just never buy there, you just don't, and that's an interesting. That the belief itself has translated into, well, now it's getting closer to fairly valued now.
Exactly, and that's what it does. That's how the market is kind of a live organism, right? Same thing with New York City now. New York City is fairly valued right now. It's an expensive city, but to your point, but it's not. The places that are overvalued are not the markets that are expensive. The places that are overvalued are places like Phoenix. And places like
my goodness.
Boston. It's the up and coming cities are overvalued because they've gotten a bit too up and coming, apparently.
Trying to make the connection from the residential side to the commercial side is very challenging because the data sets really aren't there, and that's really tough for data scientists. But it seems like the intuition, you can just kind of go with an intuition that we learned from this type of data, is that if a market is really been hot for a couple of years, then the reality is it's probably going to have a tough, long, slow slog back up after the price correction. Can we maybe use that as a heuristic? Even we can't say that because we don't have the data to say that, but maybe the intuition, and it feels like that's a correct intuition at least.
It does. Yeah, it does feel like, I mean, to me, it feels like just because I see the exact numbers in the housing market and that I'm able to, those exact numbers, I know their predictive power. So let's say metro areas predictive power is close to, it's in the 80% in correlation, like close to 90, like counties is like in the 70%. If you go to like neighborhoods, predictive power is going to be low. I haven't even measured it for like zip codes and everything because I don't have all of them. But it's but basically it would be like not predictive much for neighborhoods. Actually, neighborhoods are not even fundamental, by the way. If you take something like a city, it behaves almost scientifically. It's like you can track all that stuff. And so that's kind of the observation that I have, at least in data. If I take a neighborhood in a city, it's not scientific. It's not something that I can just use it indicatively.
You just hit on something, and again, this is a complete back to the macro in the macro podcast. There is a fun debate right now in economics about the traditional PhD level belief is all macro must be macro must be micro founded. And what you just said to me, it supports the counter, the critique, and it's considered to be like almost radical. That macro, you can't break macro down because it's its own level, and you can't break it into a further component. You can only look at it from a macro. You have to model it at the macro level. And so that's it's actually a very hotly debated, contested viewpoint in economics right now.
Oh, you're making an interesting point. But I mean, that is quite interesting actually, because I mean, for instance, in real estate, we hear a lot the term like real estate is hyper local, right? But the way I think about it is, I mean, first of all, how I agree with it, generally speaking, but how hyper local it is, excuse me.
Right.
The perspective that, let's say, anybody who just picked to invest in Florida this cycle, or picked to invest in a few Western states, a fairly big percentage of the variance that they experienced came from even picking the state. Right. Even just if you were in Florida, simply Florida, anywhere, you could have bought in a ton of counties in Florida. It's not just Miami and Tampa or whatever, across the board, and you would have done really well. And so in that case, the macro, if you will, like the state level, determined a lot of the performance. Now, from there, you could have been picking like your cities, your neighborhoods, and so forth. And now my answer usually to this, like sometimes because I run like some of these studies at these bigger geographies, right? And then like sometimes some of the critique I get is, this that I just mentioned, real estate is hyper local. So how do we care about like that state or that county or that metro area? So in the end, it's just our neighborhood. And the answer to this is, okay, I actually do this thing for neighborhoods too. I'm able to do it for neighborhoods. But the caveat is your predictive power drops. So this is what life is, right? So if you can get something, again, I agree with that things are hyper local. I want to get the best, let's say New York City, I want to get the neighborhood that is going to be the best neighborhood that's going to perform the best, right? But the question is, what's my likelihood to do that? And if my likelihood reduces a lot, but I'm going to get the state correctly and I'm going to get the metro area correctly, it could be that my expected return on guessing those bigger geographies is even higher than guessing the neighborhoods with its expected return with a lower likelihood, right? So there's like this type of thing. It's just how much are you going to gain in the end that the likelihood of actually achieving it. And so it could be that the neighborhood outperforms because you're able to pick neighborhoods well for some reason sometimes, and that's optimal. But it could be that if it's not the case, and that's the example of downside risk. So with downside risk, it appears to me like if I pick, let's say, metro areas, I can use that like almost as hard data. I can say which now for our investment, like in my company, I can say, okay, which metro areas we invest in. And we're picking, like I said, like we have like 3 metro areas now for my current 3 acquisitions. All of them are fairly valued and in undervalued counties for some of them even, and so forth. And I can pick that because I know, okay, that's gonna hold. This is accurate. Those whole cities as a whole roughly are not gonna decline much. Now, the neighborhoods, I'm not gonna pick perfectly because it's harder. And but I'm not able to devise a model that proves that anything's going to work for that neighborhood, that I'm going to get a high predictive power. Right?
Yeah.
So it's all like this. It's just like, sure, everyone wants like a very, I would say like a very big gain from something, like, but like what's your like low hanging fruit, as you call it, or so it's like there are things that you can just achieve that are evident and visible to you easier. And so that is kind of the answer to that. But yes, there are certain things, like to your point, there are certain things, in my view, fundamental studies, if you get overly granular, I don't know if there is even a concept that applies to something that's overly granular. If you're trying to relate home prices to household incomes, but if you now go and you just do like a circle of like 1 mile around your house, I don't know if that's going to behave very well, to be honest. I think that can be a bit too granular, and that can be that it's just not a fundamental market. Because it could be that in that 1 mile radius, I don't know, like all the houses get bought maybe by a foreign investor who is doing something, but there's just some noise to it, you know? And so not everything is, like fundamental and is subject to fundamental studies. And to your point, a bit more macro things are better subject to fundamental studies. Because if you have a whole city, and you aggregate all the incomes in that city, it's kind of a meaningful thing. If you aggregate the incomes in just your building or something, it's maybe not such a meaningful thing for this type of study. And that's all. Yeah.
It's fantastic stuff, and I have a feeling we could continue our deep dive into quant in real estate, but I want to be respectful of your time, Stefan. If you have an ideal client that could use your data, it seems like lenders would be a good client for what you're working on in terms of your data business.
Yeah, we had this discussion like before. Yeah, basically, companies that purchase, that invest in credit, in real estate credit, that purchase mortgages, they are one potential client of like overvaluation type of data. Funds, like investment funds, who are able to buy deals from other sponsors who are not tied to a specific market, they would be another one, I would say. And yeah, definitely.
And if they want to reach out to you, what's the best way to get a hold of you?
Yeah, so the best way is just my website, realtyquant.com. And they can find me on LinkedIn as well, Stefan Tsvetkov on LinkedIn. So,
and guys, I will put that in the notes for the show, and make sure if you want to reach out to one of the brightest minds in the business. Thank you, Stefan, so much for the time today. I feel like my IQ points go up every time I talk to you, and I look forward to learning more from you in the future. It's very nice to see you.
Oh, thanks, Douglas. Appreciate it.
It's good to have you.